Hey, good afternoon, everyone. Thanks so much for joining me today in the battle room. And what we're going to do today is we're going to go over uh, calendar spreads, and we're going to go over horizontal spreads, both ways of leveraging time decay or theta, and also leveraging our anticipated difference in the direction that the stock is going to go. And what I wanted to do was start with calendar spreads. Now, what we want to do is, and I've heard people describe calendar spreads in all different ways. Calendar spreads are way of leveraging theta. Now, you already know that I'll just to do a quick recap. If we buy an option with a lot of time premium, say it has 9 months of time premium. In the first 9 months, we're going to see very little decay in the options price. Um, After 6 months out, we're going to get very little decay. After another 3 months out, we're going to see much more decay. And then after that last 3 months out, we're going to see a large amount of decay. So in each particular case, on both of these types of option positions, we're going to have an options position with a much longer dated expiration date paired with an option that has a much shorter expiration date. And I've heard of these described in many different ways as plays on volatility, but I really believe that they're plays on theta and they're plays on time decay. So what I'm going to do is take this out. And let's take a look at how we're going, the right place to take the trade, what our strategy is going to be. And now let's take a look at Facebook. Now, Facebook right now is trading at $358. Now, let's say that we wanted to take now, first of all, let me just bring up Ping. And we're going to talk about the calendar spread. Now, when is it optimal to use a calendar spread? Now, obviously, you can always buy a call or you can always buy a put. But if your anticipation is that of very little movement, what you're going to do is you're going to want to buy a calendar spread. Now, you could buy a straddle, but a straddle has unique properties and potentially unlimited downside. So we're going to stay away from that. We're going to take a position that's a lot safer. So what we're going to do on a calendar spread is we're going to pick a strike price or strike date. And we're going to pick a strike price and make the assumption that the stock is not going to move much. So to take a calendar spread, you have to be bullish / neutral, or bearish / neutral. You're making the assumption that the underlying stock is not going to move very much in either direction. It's going to stay as close to the strike price as possible. Now remember, when you trade options, there are 4 directions. There's bullish neutral, there's bearish neutral, and then there's bullish, and there's bearish. Now, if you're bullish or bearish, you're never going to consider a calendar spread. You have to be one of these 2. In order to use the calendar spread. Now, you're going to take the trade, and I'm going to show you how to set it up. I'm just going to drop this. I'm not going to, we're going to use options play to sort of demonstrate what we want to do. Let's say we're looking at Facebook, and this is all hypothetical. Facebook took a little bit of a haircut today. Had good earnings, but was complicated by a lot of other things that they said during the release of their earnings report. Now, we're going to have to create the position ourselves. Well, so let's say that we're going to anticipate that Facebook is going to stay right around 360. Now, I'm only using this as an example to show you the metrics and all the anticipated possibilities that can happen when we trade it, how we can leverage it, how we can modify it, and all the things that we can do to roll it over, potentially open up the position a little bit more. I personally, obviously, would not be trading a calendar spread on Facebook. It's way too volatile, and it's going to move a lot. On certain energy stocks, on certain pharmaceuticals, these make really, really nice trades. When a trade's really missed its earnings or had something really, really bad happen to it, and it just hits rock bottom, and it consolidates and it sits at that bottom. It could sit at that bottom for weeks or months. So I'm not going to go into where I look to trade a calendar so much as to give you all the numbers behind it. So let's create a calendar on Facebook. Now, the tool is recommending the September 17th strike. So we're going to go with that. So actually, why don't we go out an additional month? Go to the October 15 weekly. So what we're going to do is we're going to buy the October 15 and we're going to sell. We're in August or we're in July. Why don't we sell the August? Right here. Now, this sets up a trade where we're going to make the most money. Let me go back to the trade first, so just so you can see it again. We've got the October 15, 350 call. Now, this is obviously not set up right here. Let me go to the modify. Now, here's the trade. Now, unfortunately, what I did not do is this. I have to modify the strike to 355. They both have to have the same strike price. Now it's giving us a terrific options play score. See, the strategy is neutral, and we're going to look a little bit at the metrics first. Now, the cost of the spread is $910. Now, your maximum reward is $591, but your maximum risk is $910. So let's look at where we're going to make the most money with the trade right at 355. That's exactly where we set the trade, right here. The strike is 355. We're going to make the most money if price just sits exactly where it is now. And here's the edges at 370 and change to the upside is right where we're at break even. At 341, about 342 to the downside is where we break even. And as the trade starts moving further and further bullish, that call we sold is going to start to make a lot of money, and it's going to start to put us in the red. As price begins to drop, that call we bought is going to start to put us in the negative, overdrive the call we sold, and we're going to get redder and redder and redder and redder. So our anticipation and hope is that we stay right around 355, and that's our maximum profit, which is $591.32. So let's take a look again at the metrics. Well, right here, 591.32. Now, the maximum risk is 910, not a great risk to reward. Here are your break evens, 341.96 and 369. So so Facebook can go down as low as 341.96, go up as high as 369.76, and you're going to make money. Obviously, maximum profit is right if Facebook stays exactly where it is. Now, this is true on any financial instrument that we trade. And obviously, what we want to do to leverage a calendar spread optimally is to take it, is to use it on an underlying stock that we anticipate is really not going to move very far. So that's our goal, is to find something that is just trading sideways. It's in consolidation. Our anticipation is that's going to stay in consolidation, and that's when you're going to want to move in, and you're going to set up a calendar spread. Now, let's look again at the trade. Now, right here. Now, if August 22nd comes around, now we sold a 355 call. That's a bearish position. So we want the August 355, that option, we want that to close out of the money. So we just want the price of Facebook to be just a little bit above 355 to give us 100% of the net credit we received when we sold the 355. If Google is, Facebook is 355 and a nickel, we're going to collect 100% of our net credit. Now that's $10.80 we have on the position in the bank, locked away on it, and is ours. Now there's a lot of things that we can do with this position to play around with it. and to modify it. Now we're sitting with a 355 call. Now we initially paid about, you can see we paid $9.10 for the spread. We've got $10.80 in the bank. And so we don't have this position free and clear, so we want to hedge it. Because if Facebook takes a big nosedive, it can cost us $19.90 potentially, and still leave us in the lurch. So we can always roll it to the monthly option here. Now we're selling this, and we're gonna get a huge net credit for this because we're approaching the expiration date. Now remember, the key is that theta or decay is starting to become fairly close. The October option is going to decay in price slower than the September option, but not a huge amount so. The August was going to decay in value really significantly quicker. So this is a much safer trade, but if this is in the bag and these expire worthless and we're left with the 1990 spread, we don't have to close the position. In fact, I think it would be kind of silly to do that. So what we can do is we can remember, we're neutral on the position, and our anticipation on the trade is now not all of a sudden that Facebook is going to take a big move up or a big move down. We remain neutral on the position. Now we're trading a September calendar spread, but theta or time decay is only going to affect the September only a moderately amount more than it's going to affect the October. Now you've already locked in a lot of profit. Now, if we look at the metrics on this trade, we risk 425 and our potential reward is $634. This is the September-October calendar spread. So we're not risking a lot of money. You already have $10 in the bank for each position that we bought, or really $1,000, and we're risking $425 on the anticipation that Facebook is still going to continue to trade right along in sideways fashion. And if we look right here, now here's the new position. The cost is 425. The maximum reward is 634. And here are our break evens. 339 to the downside, 372 to the upside. And if Facebook closes anywhere in here, we're going to make decent money. Obviously, the closer it stays, right there to 355, which is our strike price on both, the more money that we're going to make right here. And again, what we would optimally like to do is have the September call we sold expire out of the money with Facebook closing just above 355 again, leaving us with a worthless call position that we sold and it's out of the money. And we get to keep another 1565 of profit. Now again, this would be a great time to close out the position. You're not going to want to take an October 15, because you want to leverage theta, and there's no theta leverage in that type of position. In addition, you've already banked $25 per position per the last two positions on the trade. That's $2,500 for every spread that you created. So you're in it for a lot of money, and you've really milked it for all it's worth. And your anticipation is still sideways movement. So you can set up another calendar, but obviously this position, you're done. What I would recommend you do here is you close this as a, together. And what you're gonna make is right here. We looked at the metrics. Your maximum reward is 634. But obviously, you're going to make a lot more money. Whoops, I closed the position. Let me see if it's still here. If you leave that call position open, I think it might have vanished. It did. Now you would, but what you have is a very, very expensive call position hanging out there. Now, it's trading. You will have lost money on that position, because that position will have degraded in value because of the time premium or theta decay. So the best thing to do in that position is simply zip it up, close it up, take your profit, and you've done really, really well on a calendar spread. Your first roll, the call you sold closed out of the money, you got to keep the net credit. You rolled it over, the next call closed out of the money, but you're gonna close up the entire position. Now obviously, if you take any stock and the further out, and we're gonna modify it again, the further out that you go on the position that you buy, let's say you're going to buy and take it all the way out to January of 2022, and you're going to sell. Well, here we sell this September, and we have to go to the same strike price, right? 355. I don't even think it's here. Oh, yes, it is. I'm sorry. Now, this is obviously a lot riskier, because your anticipation here is that Facebook is going to be trading in this narrow range over a very, very long period of time. Now, there's nothing wrong with doing that on another type of stock that trades sideways for an appreciable period of time. And just because, and remember, after your first spread, and here's the metrics on it, we can look at it. Our break even is 336.79 to the upside, to the downside, 377.19 to the upside. I mean, for Facebook out to January, obviously that's crazy. But we're using Facebook as an example for a position that we believe is going to move sideways. So you can take the position as far out as you want. The further out you buy the call, the better and the more money you can make on a calendar spread, because you can leverage theta or time decay better and better and better when you buy the back month or sell the back month call. Let's take a different stock. Let's take Pfizer. which of course I forgot the ticker. Hold on, let me look in my app. Let me get Pfizer. It's great. I don't even know how to sell it. How to spell it. All right, you know what? This is a little more volatile. But let's look at Abbott. Look at Abbott Labs. This is a pharmaceutical company. Let me go to ABT. Right here. Now you can see this is a pretty rudimentary charting tool. That Abbott here is considered to be in a neutral position over the course of 6 months. And we're not going to, one thing we're not going to do is use that as a charting tool. But at least it's nice to see that they're anticipating that Abbott moves sideways. It's got resistance right here at 125, which is good. This is really just, very rudimentary. Now it filled the gap really nicely. Gap down, came right back, and filled that gap. I'll tell you, as much as I hate rising triangles and falling triangles and all the other stuff, stocks really do want to fill those gaps really desperately. And I would have to read up more into why that is, but they really want to close those gaps, and Abbott came right up and closed. Now let's say that we're going to anticipate that Abbott's at 121, and the furthest we can go out here is 6 months. And that's really a good look at the stock. I mean, it's a good snapshot. I mean, going out a year isn't going to tell us any more than going out 6 months on Abbott. And what we're going to do is we're going to modify a trade, and we're gonna take Abbott out. Let's see, it's trading around 121, so we're going to look at the 120 strike, and we're going to move this also to the 120 strike, which gives us a great. We're going to take Abbott out to December. Now, I don't think it has a December, so we'll take it to January. So we're going to buy the January 2022 120 call, and then we're going to sell a much closely dated. In fact, why don't we sell the September? It's July. That gives us 2 months, and the 2 months gives us a decent amount of premium on the trade. If we sold the August, we would make a lot less. We still have tremendous differential between the two expiration dates. So time decay or theta is way in our favor. If we look at the metrics of the trade, we can see that the cost is 380. The max reward is 266. And you're not going to make, the risk to reward on a calendar is never going to be tremendously in your favor. It's just the nature of the trade. So here are your break evens, about 114 to the downside and 126.89 to the upside. and that's a pretty decent break even. Now that's an option. That's at the expiration of the entire spread going out to its final strike point. So if we close it back down here, that's the expiration out to January 21. Now, if Pfizer again stays right around 120 and just gives us 120 and a nickel, and even if it closes a little bit below 120, we can still buy it back at a very, at a really nice. It's going to have some intrinsic value, so we could let it expire, or we could buy it back. And buying it back, we're going to buy it back really for almost nothing. It's going to have almost no value at all. We're going to keep almost $395 on the position and be left with a $7.75 call position. Again, with their anticipation, and look at the score we get on options play. We have a neutral technical score on Abbott. I've never seen 166 before. Now, these are the risk to reward. I mean, we can look at the at all of the Greeks right here. It's a neutral strategy with limited risk and limited reward. The strategy will profit if the stock closes between 114 and change, 126 and change. Oh, and this is by September 17. So that's a September 17 metric. There's a 50-50 probability this will happen. That's an extremely high probability. Normally, these probabilities are about 33% on the best trades that we can configure. So the delta is 143. The gamma is 2.39. Theta is time decay is way in our favor, and I really don't spend too much time worrying about Vega. All I care about is to know that the Greeks are really significantly in our favor, and we can know that by this options play score of 166. Now, if again, I'm just sort of running through it again. If the September 120 call we sold provides us with a nice profit, a nice net credit, even if we have to buy it back, if we look at this option alone, you can see we've got $3.95 to the downside, $3.95 to the upside, and really this is where our focus is on. So even if it closes a buck at 119, we're still going to have $2.95 a net credit. We're going to close up the position and be left with a January expiration, 120. Now we will have lost some money on that January position, but we will have gained. We actually want this to expire worthless. So this is going to increase in value. We don't want that. We want this to expire worthless. But we can then roll it over from September to the October. Let's take the weekly October. We can, because there isn't any. So we'll just have to go to the November. And we still have theta decay or time decay. Probably enough. Now we've already locked in, let's say about $3.50 a profit, $350 per spread. And now we've got a November 13 sold at $6.05. That's a nice amount of money. Only now time decay is getting, they're starting to, they haven't reached parity by any means. There's 2 months of difference between the two. And if we look at the metrics on the trade, here the cost, I mean, remember the cost here is actually going to be less than it shows because we already own the 120 strike, and we're going to be selling the 605, and all we're going to be doing is getting a net credit for that. So the cost to us is essentially going to be nothing. We own the 120 call. We're going to be selling the November 19th 605 call against it. And what they like, what I've seen this referred to is as the poor man's covered call. We're using the longer dated strike as a proxy for the stock, and we're selling the call as a proxy for the covered position to cover us if the option or the price of the stock falls. But in a now you're going to make most of your money on a covered call if the stock stays pretty much exactly where it is. But on a covered call, the only reason you'd write a covered call is if your anticipation is that the stock is going to fall. You don't want to sell the stock, so you simply sell a call against it to make money in that particular situation where you're going to get a retracement or a pullback. You still own the stock. For every 100 shares of stock you own, you're going to sell a call and you're going to make money. In essence, this is pretty similar. You know, you bought the 120 call and you want to cover yourself by selling a 120 call. And every time this position moves down, you're going to make money on the position that you sold. But remember, on both legs of a covered call position, the stock doesn't decay in value. Here, you're getting time decay or theta in your favor. So that November position is going to decay a lot faster than the January position. The linchpin of the trade is that Abbott stays fairly close to 120. Now, if we look at the metrics of the trade, here we have a really nice metric. I mean, this can go all the way down to 120, up as far up as 128, and all the way down to 112. And we've got only 1 month for that to happen. That's a big move on Abbott Labs. I mean, this closed the gap fast. But if we look here at support at 114 and here at resistance at 125, it traded within $8 of itself for months, moving sideways here. So only when the gap occurred and then the stock looked to close the gap that it fired back up. Now that it's back into this zone where we've got support to the downside at 114, resistance to the upside at 125, our anticipation is that we're going to go right back into that same sideways movement that we've been having previously. So we've got a really nice score. We've got a really nice risk to reward. We've already got a lot of nice money in the bank. And we're going to hope that the trade stays really close to that 120 expiration, where we're going to bank almost 100% of the option we sold, and we still have let's say that we make 80 to 90% of the option we sold. That's a hefty profit. And this is going to undergo theta decay or time decay a lot faster than our January. Now we're losing money on the January while we've made money on the 2 calls we sold. Don't forget that. This 775 is the time premium. Actually, that's the time premium it's giving us, or how much it would cost us. But you know, we're moving out here. So if we bought it a few months ago, we're going to lose money off this. This is the cost if we bought it right, you know, immediately. So if we bought it today, obviously, if we bought it today, this time premium is not going to change. You can see off of the chart that the time value of the call is going to decay to the downside. This is with stock price, but also with time decay. So it's adding them both in here. So we can sell that 605 if we make 80 to 90% of it. You still have the option. I wouldn't take this option of going to the December. There is no December. You have to go to February. So you know, right around options expiration, which is going to be the November week, or any time previously. If you're up a lot of money, you simply close down this position, maximum profit on the position is going to be $285 per spread. So this is how you can trade a position that you believe is just going to move sideways over an appreciable period of time. In today's market, that is really not that easy to find. But the pharmaceutical companies, some of the energy-based companies, I mean, I can think of quite a few companies that that just sell sideways, and they don't have, obviously if they don't have a lot of volatility, the premium that you're going to pay for the call is going to be small, but the premium that you're going to get when you sell the call is going to be small. But that's okay, because you can simply increase the number of spreads that you create. So the amount of money that you want to potentially make versus the amount of money that you want to risk is still going to be way in your favor. Now, one of the stocks that I'm thinking about is XOM, is ExxonMobil. Let's let it think about it for a while, and then let's show you a different kind of position. So now here, this technical score is very strong, and I would be really careful about ExxonMobil, because ExxonMobil can really make a big jump to the upside. So maybe that's not a great example. Look, let me try. See, Range Resources is also giving us a very strong technical score. So, I mean, these are 2 positions we hold in the options portfolio right now. And what's the best thing to do when you have a trending instrument is to either buy the call or buy a bullish vertical spread. That's the way that you're going to make the most money when you have a trending stock. So this stock isn't bullish or bearish to neutral. This is bullish, and this technical score is really quite good. You know, it is not overly sophisticated, but on a rudimentary level, it gives you a lot of good information. So it gives you support and resistance, and I really like that. Here's your resistance right here. And it's going to give you resistance right here. So you have 14.41% off the price of the stock before it hits resistance to the upside, which is pretty decent. except that it's giving you a technical score very strong. So I would stay away from it. Let me see if there's anything I see in the portfolio that's been moving sideways. Actually, I can tell you one. This is not going to make you a lot of money. It's Hims and Hers. And now obviously this is a position that I bought on a bullish vertical. And I'm not here to tell you I call them all right, but what I did was they don't even give you a vertical spread, so we can't even anticipate what the move will be. It's so bearish. Now, the reason I bought it was because Miley Cyrus and Alexander Rodriguez came aboard. Between the two of them, they have about 25 or 30 million Instagram followers, and they're producing their own cosmetic line. Now, obviously, it just didn't matter. Now, Hims and Hers has a lot of time on it, but you can see even in a strong market like today, it's down 4%, and it may be just a position we bail on. And maybe I should have bailed on it a long time ago. Let me go to another one that I think is moving sideways. Let me look at it here. This market is so volatile. It's really hard to get a position that you anticipate is just moving to this. It's moving sideways. It's going to stay that way. I mean, everything I have is just really very volatile to the upside or the downside. And it's very hard. The ones that are not so volatile are just are just inexpensive positions. Let me find one here. All right, here's one that may work. Now, here's T-Mobile. Now, the technical score is weak. It's a 4, but look how it's trading. Now, it gapped down here, and it's really trading sideways. Now, this is a bearish strategy, and we're neither bearish nor bullish, but I think this is a position that you could conceivably create a very, very nice calendar spread on, anticipating that T-Mobile is going to trade very close to 28, and it's not going to make any precipitous moves. Now, personally, I think that T-Mobile has a bullish, it's my sideways to bullish bent, and the reason I believe it is because somebody has moved in, and in 2 separate transactions bought 5 million and then another 5 million block shares to the upside. So they believe that T-Mobile's bottomed out. Only this is not unusual options activity. This is not insider buying either. There was no Form 4 created. This is simply some huge investor or bank or whatever you have coming in and buying in 2 separate transactions, maybe by 2 separate investors, 10 million shares of T-Mobile. Now, we know it's not going to be a big mover in any specific direction. Now, the strategy here is bearish, but we don't care what it shows here. We're going to modify the trade to suit our needs. Now, right now, it's trading right around 28.43. So we can place the strike at 29 and 29. Now, we're going to take this position out, and we're going to take it all the way out to January 21, 2022. And we're going to make this a call. And then we're going to sell a call. Look at that. And we're going to sell a call, and we're going to sell a near dated. Now, if we let's see how much premium we get. So we get almost no premium. We get 23 cents. So let's try the September. You know you're not going to get a lot of money. Now this isn't bad. You're going to get $42 per spread, and the whole spread is going to cost you very, very little. So you're going to buy the January 22, 29 strike, sell the September 17, 29 strike, and here's the metrics on the trade. The cost is 58. The maximum reward is 88. Now, this is a really good, this is telling us we have a 76% chance of getting a win here. Days to expiration are 60. And we've got an unbelievably, see, it's mildly bullish, mildly bearish. They call it the 1M and 6M band. That's a terrific potential trade. And let's close it up again and take a look at it. Now, if Pfizer, or I'm sorry, T-Mobile, right now, this $29 call we're going to sell is in the money. And that's really okay. Doesn't make any difference. We're on this position, we are bullish to neutral. So we're going to make money on the position if it stays right where it is. On the call we sold, we're going to get 42 cents of net credit, or 42 bucks. Again, when you trade stocks like this, you're not going to get massive profit. This is a conservative trade that gives you a conservative amount of money, but has a tremendously high win rate. So if you want to take this kind of trade in a very, very choppy market, there's absolutely nothing wrong with it. You can create 10 spreads here. So this $42 is going to become $420. Now, again, we have the metric for the trade. It's going to do the best if it closes right around 29. And here, now, if it goes all the way down to 26, which is really unlikely on T-Mobile. I mean, T-Mobile moves 25 cents a day. If T-Mobile moves 25, today it moved 41 cents. I mean, this is a lot more than normal. You've got yourself in 2 months a very nice window here between 26.84, almost 27, and 31, almost 32, for this spread as a standalone to trade profitably for you over 2 months. Now, obviously, what we want is just, I'm sort of recapping again. We want this $29 call we sold to give us 100% of our net credit. And the way to do it, it either stays where it is now or it gets right above 29. So we need 56 cents to the upside, and we're cooking with gas. And we just need it. Very little movement. We've got a buck to the upside, so we're only going to lose money if we just look at it call by call. If Pfizer closes above 30 to the upside on the call we bought, or below 28 on the call we bought, we've got a lot of room here, because remember, we are mildly bullish on this position. I mean, I really like T-Mobile, and I told you, with 10 million shares just purchased in the last, I think it was about 10 days ago. So let's say we get 100%. This is one we can definitely roll over to October. And now we've created a new position. Now, this is how much you would get paid if you took the trade today. This is obviously not going to be the metric that you're going to get if you take the trade in October. But you're going to get a nicer net credit because you're getting closer and closer to the long call you sold, but you still have a nice differential in time decay. That October 15 is going to really start to disintegrate in price and the potential to take. Now, again, if you do 10 calls, you're going to make another $590. Now you can still take the November. There is one. We'll take the October. We have the October. Now we don't have any more opportunity because on T-Mobile, all we have is the January. So we have 2 opportunities to make money. Now I just want to differentiate a calendar spread. Whoops, excuse me, one sec. One sec, I'm sorry. Okay. Okay. My son is moving home in the next couple days. The summer is here, and I've got to go down to the school, to his school, or up to his school, and help him move tonight, which is really going to be a joy. So let's take a look. Instead of a calendar call, what we're going to do on this position, we're going to look at. Hold on, I'm sorry. This is just spam, just a spam call. Okay. Now we're going to look at neutral strategies. Now, obviously, I don't agree with this. We're going to look at the diagonal. So let's look at a long diagonal on the same position. Oh, Jesus. And now the diagonal is going to give you different strikes, and it's going to give you different expiration dates, but it's looking to leverage the same thing, and that is theta decay. You're selling the $30 call. Now, right now, T-Mobile's at 28. You want it to get to 29, but you don't want it to get to 30. Now, I really like a long diagonal call. It really can be extremely profitable. If you just hang on one sec, I'm sorry. Okay. So we're going to take now right here, we know that we have major resistance at 30.30. So we do not want, we have no resistance through 29, but we don't want the stock to eclipse 30. We've got resistance right around 30. So we want it to go up. This is definitely a directional trade, but it's not a strongly directional trade. The key is to get it above, is to keep it, is to get it above 30, but it doesn't eclipse 30. And actually, really the key here is to get it above 29. We get it above 29, we start making money on the call we bought, and the call we sold is going to start to erode in price. It's a hedge, and it's a great way to trade a stock that you want to hold for a long period of time. I'm going to give you a little bit of a different example. Let's take Bausch Healthcare. look at this. So here it is. Now, Bausch Healthcare has had huge trouble holding 30. And we've been in Bausch Healthcare for a year with Bausch. Now, when I initially placed this the position on Bausch, all I did was buy a call because I was very, very strongly bullish on the stock. Now I'm sort of bullish neutral. So if I had to buy it today, what I would do is I would modify this trade, and what I would do is I would take a long diagonal. Now I would look out to October for Bausch, and actually what I would like to do is modify this. I would like to take the October out to January. That gives me all the way till January for this stock to eclipse 30. But we don't want it to eclipse 31 because we sold it. We want it to stay in the money, out of the money. If it eclipses 31, it's going to be in the money. So we want it to stay below it. And so this is the kind of position I would take. I would take a long diagonal call, anticipating a move through 30 into January, but not a move above 31. If I want it to be a little bit more, I could always go to 32. This will give me a less net credit on the position I sold, but it still has to eclipse 32. Remember, this is a bearish position. We want it to stay down. 32 is its strike. If it gets above 32, we obviously are going to have trouble on it. But it has till September to get above 32, and it ain't happening. So obviously we're not making a huge amount of money on this position we sold, but 83 cents is not bad at all for a 32 strike. And if we go to the metrics, the cost is 252. The maximum reward, if we look at it in the aggregate, it's $1.70. It's got a 50% chance of coming through for a nice winner. And we're really looking at this trade in piecemeal. Now we know you can see it doesn't have it. Well, it does have a symmetric. We're going to make the most money if Bausch stays right pretty much where it is. So that tells you right off the bat that it's pretty much, a neutral position. You're going to make the most money. Actually, you're going to make the most money right here. I'm sorry. You're going to make the most money right at 32, because at 32, if we go take this out, right under 32 is where you're going to make most of your money. You're going to make maximum profit on the call you bought. And if it just closes at 31.95 or even 32.05, you're going to keep almost all of your net credit. You're going to buy it back if you have to. Hopefully the position will expire worthless, and you wind up with a nice juicy net credit, $83 for every spread. Now this is an expensive call, but it's only a 30 strike, and look where the stock is trading at 29. So it's very likely. Now it has broken 30 multiple times and just can't hold it. I believe it's going to break 30 this time and going to hold it. And I think we're going to get a move all the way up to that next area of resistance right here at 34.75. Actually, it's right here. It's 34.80. So we can potentially get a 17% move to the upside. That would really take the call that we bought and put it in a great position. Now, here's another reason I really like this position. You don't have to go in and sell another call unless you want to. Now, I would potentially want to, because the call you're in is $3.35. Let's say you only had one position. So you're going to have $83 in the bank, which is going to reduce your cost basis significantly on the call that you own. Now, you're mildly bullish on the position anyway, so you think it's going up. But let's say you're going to roll it over. So let's say you go from the September to the October. Now, this is the price today, remember, not the price in October. That's a long way off. You're going to get $1.20 of premium for that if Bausch is still sitting right here. That's probably about what you're going to get. So this makes a great long diagonal, anticipating a long trade, but not a super duper powerful long trade. Because if you were anticipating a really strong trade to the up, then you would take the vertical. And the vertical is going to give you an October 29.34. And I would knowing that I've got resistance right here. See, I mean, I would take that trade, but I would push it out to January, and I would keep it down to 34, because that's where we know resistance is. I don't care what the options play score is. We know on a practical basis, we're going to hit resistance at 34.75. This is a cheaper spread. If we go to the trade, it's only going to cost us 219. The reward is 281. It's tilted in our favor. If we look at the metrics on the trade, the break even is 31.19, and we've got all the way until January 2022 to hit 31.19. Now, we do have resistance here at 30. So you'd have to make the anticipation that you're going to break that resistance and hold it. I believe it's hit so many times and failed. If we go back and was all the way up to 34 and retraced, I think we're going to get a nice move to the upside. Obviously, that's my anticipation, and that's the anticipation on the trade. But I think at 29.34 puts the risk to reward very nicely in your favor, and you're going to start making money very, very quickly on this trade as it starts to move to the upside. I just want to look at it again at the cost, and let's look at the break even is 31.19. So we have about a buck and change to the upside to evolve over the course of almost 5 months. So I think this is a great way to trade it. So we've got a couple of different ways that we can trade. We can trade using a diagonal, and a diagonal is really for when you really believe that the position is going to move sideways. Now, this is the best tool I've ever seen for giving you at least a ballpark figure on where the diagonal is going to, where the optimal diagonal is. Only diagonals are very, very easy to calculate, because you want to take a strike price right near where the stock is, 29 and 29. And it's simply a matter of deciding how far you want to go out. And remember, the further out you go, the riskier the position you're taking, because you're making the anticipation that Bausch is going to stay right around 29, all the way out to January 2021. If you want to pull it in, you can go to October 15, and then you can sell against it. What we have this September, and here is our vertical that we've just. I'm sorry. Here is our calendar spread that we just created on our own, and here's our metrics on it. The cost is only $62. The maximum reward is 76, but we have to have the anticipation that the stock is going to trade right around 29. I mean, look at the net credit here. Now, that's today. That's one heck of a lot of net credit you're going to get. But I have to tell you, but you're taking an in the money. I mean, it's 29.68 and you're selling it. So this is an in the money bearish position. So you're getting one heck of a lot of loot for this position. There's your call position. And that's in the money. That's out of the money. This is actually a pretty decent trade. The issue here, though, is that Bausch all the way out has to stay right at 29, and I don't believe that it's going to. So I think you're going to get an appreciable move. And let's take a look at where it can trade as low as 27, but our upside is 31.12, and I believe we're going to eclipse that. Now, I just want you to know one other thing. You can always create an additional position on a calendar spread. Let's say the trade is moving against you, but you still believe that it's going to eventually achieve a horizontal position. If it's moving against you to the downside, you can sell another call that's lower. I'm sorry, that's got a shorter term strike, or you can buy another call that's got a shorter term strike to widen your gap here. And I've watched trades where they take the two and they mold them together, and they just do that. There's no tool that'll do that for you. And this doesn't allow us to do it. I think Thinkorswim might. Like we can't create a third position here, which is what I would like to do. It was like to add another buy at a different strike price and another sell at a different strike, but I can't. So you can always modify your positions, and if you're in the trade, we're going to modify those positions together if they move, if it threatens to move against us. Obviously, our other option is to bail out of the trade. So we have those two ways that we can do it. But this is not a good trade for a vertical. I'm sorry for a calendar, because I think this is moving up. And I think Bausch today has moved up really nicely. Let me just take a quick look. I may be wrong. I haven't looked at it that carefully. Jesus, MasterCard is going absolutely ballistic. We need a couple of stocks going ballistic. Bausch is only up 7 cents today. So it's negligible. Now, let me give you one other sector. Boeing's up really nicely. ExxonMobil's up nicely. We've got a lot of stocks that are doing extremely well today. Now, certain cannabis stocks will move sideways for forever. Now, I mean, Hexel almost warrants a bear put spread. It's too strong. It's too weak. Its technical score is 1. We want a technical score of 4 to 5. I don't have one, but cannabis and pharmaceuticals are two sectors that tend to move sideways for a long time. Let me try one other stock here. Waiting for it to think. There we go. Now look at Viacom. Its technical score is very weak, but look where it's moving after this gap down. Let's go to 3 months. I mean, it is trading in a very, very narrow range. Now, I can't even say, to be honest with you, that I have a bullish stance on this. The technical score is very weak, so I would say that we're neutral to bearish on the position. We've seen how low it's traded. You see it's got support at 36.71. See, I can't, no, I can do it. Look at that, right here. And it's got resistance all the way up. I mean, it's got resistance through the stratosphere, but it's just in a really poor position. So we can create a calendar spread on Viacom, and let's modify. Now, it's very tough to whether you want to I'm not sure we want to trade this, but I think Viacom on a calendar would do exceedingly well. We can modify it. Let's take the position that we want to hold long term, and let's take it out to January 2022. And we want to sell. Now, the strike price we want to set, we'll set it at 40, because I think that's the closest strike we've got. And what we're going to do is we're going to sell the September. Let's sell the August. It gives us less net credit, but I like it. So we want Viacom to stay right around $40. And here's the maximum profit right here. And you're going to lose money at 36. It's got to eclipse or break through support to get there. 45 it can make out to January, but it's really moving sideways. Obviously, that's your biggest, your biggest problem. And what you may want to do is bring in that January. Now, obviously, these are just rudimentary technicals. It's going to decrease the cost of your call and decrease your risk. And actually, now if we don't keep it out to December, we want to leverage time on the position. So we've got an options play score here. Look at that. It's 199. And we just want Viacom to stay where it is. And we're going to make really, really nice money. Right here, we're going to get almost $3 in net credit. The position, the trade itself, is going to cost us $2.24. Maximum reward is $2.24. I'm sorry, is $1.70. So maximum risk is $2.24. And the break evens of 36 and 44, I really like. Now, this is really a potential trade. Now, remember, you don't have to let it evolve all the way. If it stays right around 40, going into August, you can just zip the position up and take your profit. If it winds up closing, you can always again roll it over. You have a September position, and again, you're going to get a net credit. I can't tell you how much that is because we don't know what it's going to be like in September. But here's another way that you can trade a very, very lucrative sideways moving stock. And there are plenty of stocks out there moving sideways. Obviously, not Facebook, Google, and Netflix. But there's tons of cannabis stocks moving sideways. And I'm trying to think of one. Let me see one up here on my list here. Now, last night in my newsletter, I recommended Levi Strauss. And the reason I did is because, again, I never like to use block trading, but I don't know. There were close to 10 million shares, not to CEOs or CFOs, but just to big traders. Almost 10 million shares traded on Levi Strauss. Now, I like very much the fact that we've got support at 25 and we've got resistance right here at 30.75. So we know that we've got the stock bracketed, and going all the way back to May, it's really moved sideways. Now, insider trading does not tell us when they believe the stock is going to evolve for a profit. Today, it's up really nicely. It's making almost a 4% move. And I stood aside on Levi Strauss, which was really obviously a mistake. A 4% move up on a stock like this is a nice move, but this is another potential. So I really think you got the idea. If you had a slightly more bullish feeling based on the technicals and based on insider trading, unusual options activity, something that's a little more sophisticated than this, and you were bullish on the stock, and I'm bullish on the stock, I would be a little bit hesitant to take a calendar, and I would be more inclined to take whoops. And that's that. It's saying long vertical. Well, it just defaulted to long vertical. But I would be more inclined to take a long diagonal like that. Going out to October, the opportunity for eclipsing 28 is exceedingly high. Just because of all the information I know. If I wanted to be extra cautious, I would cap. Now the options play score doesn't like that, and you don't get much net credit for that. So we would keep it at 29 because we only have until September to do that. That's not a lot of time for this to go up $1.50, and it doesn't move very much. So this would be a potential trade that we would take. And here's our risk to reward. The cost's only $110. Maximum reward is always going to be slightly less, or usually slightly less. And here's our break evens. 27 to the downside, right where we are now. But we're bullish on the position at 33.46. This may be giving me nope, it's giving me the the metrics on this, on the position that I placed. And 37, 27, and 33. But this is a bullish position. So a diagonal spread is anticipating that we have a distinct direction. So I hope in this time, at least I've exposed you enough to getting a basic understanding of the difference between a diagonal and a calendar, when you would take a calendar, when you would take a diagonal, how you can roll a candle over and roll a diagonal over. Now, diagonals are a lot harder to roll, obviously. Now, and I'll tell you, with 28 is a terrific strike. I wouldn't want to take this out to say January and knock this to a $30 strike and take your September to a 31 strike. I mean, I'm not too crazy about that. Look how much money you get on that, 30 cents. And you can see it's very strongly bullish. You can see how the bullish stance is priced into the option. So I hope it's helped you distinguish between the two. Obviously, this is just an introduction. You know, we will go back to this over and over again. And every time now that we evaluate a position, we're not only going to look at buying the call, buying the vertical, and we have to distinguish between buying the call, selling the call, buying a call spread, selling the call spread, buying a put spread, selling the put spread. It obviously all has to do with intrinsic volatility and the price of the options. That's something that we will go into further. But what I wanted to do was just expose you to this so that you can understand exactly that we're doing. That the calendar spread is a very distinctly neutral position. And you're going to make most money if the stock stays exactly where it is. On a diagonal, you're anticipating a move up, but not that much of a move up. And a diagonal can be extremely lucrative for you. Only you don't want to deal with metrics like this. I mean, selling a $30 call in no way hedges this, really. And you know, unless you're even 10 positions is $300, and it's going to cost you $2,000 to buy 10. So I just think that, you know, this is a bad example, but I think you get the conceptually exactly what we're looking at. Now, again, if you want the options play tool, and like I said, I have nothing to do with First Trade. I've had an account with them for 500 million years. You can put 10 bucks or $100 into their account, and you get unlimited use of their tool. I mean, that, you know, there's no magic to it, but it's the only tool I've seen like it, where it sort of gives you a rough estimate. And look how nice, look at this. I mean, a buck up on Levi Strauss is really a nice move. And I hate when I know it's going to happen and I don't pull the trigger. And 10 million shares purchased on a stock is really setting you up for a long move. It may take a long time. And Levi, I'll tell you, even though this is giving you a red on this, I have no idea why. I would take this trade. First of all, I would modify this trade on just buying the call, because it's really cheap. It's trading at 27. I would take this strike at 28 and I would take this expiration all the way out to January. It's a great, well, it costs $2.80. That's why it's really prohibitive. I mean, it's going to cost. I mean, Levi Strauss is going to have to go get over $30.80, and it may or may not do that. It doesn't have any resistance. Resistance is at 30.78, but I wouldn't want to pay that much premium for this position. That's a lot of premium, but we're buying a lot of time on this position. So maybe the best way to take it is with a vertical. And it's giving you the 37.34. We know that there's resistance at 31. So let's see what the 37.31 looks like. Still got great Greeks. It's quite cheap. And if we look to trade it, the risk is $180. The reward is $220. Excuse me 1 minute. I'm sorry. I really I had to take that call. So it's $1.60, and this is a position I like. So you can see how you can play with this. You have to have information about the stock, and I'll show you again where I get it. I go through all these positions every day off of Benzinga. It's obviously a daunting task, but these are all giving me options, unusual options activity. They're giving me insider buys and sells. And there's probably, you can see there's 150 individual emails right now on these under Benzinga, and I go through every one of them. Every now and then I'll skip it, but let's see on the Russell, it's bearish, but it's insignificant. Volume is less than open interest, so we don't care about it. And you have to go through these one by one. Again, insignificant. And find out where that significant UOA is. Now, if I was able to watch the ticker all day, this would cross the ticker and I could see it without having to have an email sent to me. but I don't have the ability to watch the ticker all day. So I just have this sent out to me this way. And it's a little bit of a pain, but it's what helps me set the trajectory of the position I'm looking at. And hopefully you're getting a better feel for how to set up the best options position you can. Obviously obviously in a neutral territory. You're going to want to trade that calendar spread. It's really, I think, underused, except your stock has got to move sideways. And there's 1 ton of stocks caught in a channel. And Levi Strauss may be just one of them. But when we looked at it, it didn't look that great. See, this is what you have to do. So what I'm going to do is I'm going to go through any questions. I think all of you should understand conceptually very, very easily how to do it. Now you can set this up on Thinkorswim, except it's not going to be quite as easy if you don't know the strikes. It's going to give you your your maximum risk. It's going to give you this curve, which is really what you're really interested in, is where your profit range is right here and where your loss range is right here. And what happens if nothing happens? And like I said, this is a bullish position. We're not looking at a calendar, we're looking at a diagonal. So this is really what you want to set up. And this is what Thinkorswim will bracket, but you have to put in the positions and it'll change that bracket for you. So you have to optimize those brackets yourself, whereas this does it for you. It does explain the Greeks for you. It gives you the limited, here's your risk, here's your reward, here's the probability of getting a winner. You'll rarely see greater than 35%. And it shows risk and checklist. Target price is 34.53. Expected profit at target price is 250 bucks. Your return is 166%. And it's got, when all these are checked, you're to get that green check here. Stock trend, neutral. Market trend, up. Earnings date, check the earnings date. It's going to be in play because of the time it takes for it to roll out. Right here, it shows you the options play score. And spread and liquidity, ain't too happy with. And we're not going to look at that right now. Liquidity is based upon the difference between the bid and the ask of the spread. And I just want to focus in on the strategy right now. Now, Levi's is giving you a technical score of 9, very strong. So be careful on placing a calendar. This is where you may want to do much better on a horizontal or a vertical. Right here. All right, so let me answer any questions. I hope you got a lot out of this, because conceptually it's a lot of information. I've never seen it all stuck into one webinar, but this is what we're looking to do. And when we set up positions and when we look at stocks that we want to take a trade on, obviously setting up the best risk to reward and the best scenario you can is going to tilt the trade in your favor tremendously. It really makes an enormous difference. And what really is important is you've got to have an anticipation of future movement. If you're bullish, it's a call and a vertical. If you're bearish, it's a put and a vertical. If you're moderate bullish, you can take a calendar. I'm sorry, not a calendar, a diagonal. If you're neutral, you're going to take a calendar. I mean, that's the best way to trade it. I think that straddles and strangles do not come near the risk to reward that this does, and I think this takes the place of them. You never hear anyone talk about a straddle or strangle anymore, because there's a better way of straddling or strangling the stock than the old classical, way that it used to be done. This is a much better way. On all these positions, you have to pick an upside and you have to pick a downside. You have to find resistance to the upside, support to the downside on whatever technical tool you're using. I just didn't want to open Thinkorswim and get too complex, because the option play tool gives you a very rudimentary and nicely calculated assessment as to what it's doing. If we were actually going to take this trade, I would open up Thinkorswim. This is more about just giving us an understanding on a rudimentary basis of its direction and leveraging that direction with the best type of spread or call or put position that we can, to try to tilt the risk to reward in our favor as strongly as possible. And let me tell you, that's really all about what options are. They're about taking leverage and time decay and throwing them both in your favor. Leverage is your gamma, theta is your time decay. Delta is really going to determine your gamma, but gamma is obviously this line here, and it's ultimately derived. I mean, if the delta is big, you're going to get a nice trajectory up, nice geometric line up. Whereas the stock just gives you an arithmetic line up. See that line just straight up? That's why you trade an option. You don't leverage this, there's no reason to trade an option, and you just want to leverage it optimally. So let me see if there are any questions. Hey, good morning, everyone. I missed trading this morning. It's just, I have to go to the gastroenterologist. I'm having a lot of trouble with my stomach, and I have reflux, and it's just really bad. And this morning didn't look like any piece of cake, but I still want to trade every morning. Hey, Donald, I'm a new customer. I can't get my phone calls responded to. Okay, hang on a second. You're a new customer. I can't get my phone calls. Rory, can you please give Donald a call? Donald, if you type your number in, no one will see it, and Rory will give you a call almost immediately. Okay, Donald? And he'll go through everything with you. Also, he'll send you a lot of video tutorials. He'll get you all cranking out. So I really don't want to go into a run through of the software in this particular case, but Rory will handle it for you without any problem. Yeah, PFE. Thank you, Rishi. I just couldn't think of it. I'm just really curious on PFE, because PFE had unbelievable earnings. Look at that. Very strong technical. Now, I think it fell on earnings, but boy, on that vaccine, it has taken some move up. I'll tell you. I mean, Pfizer's a stock that doesn't move. Once it settles down and moves sideways, I'll tell you, Pfizer can sit there and do nothing for about 3 years. So it's always a stock to watch if you're looking to create a low risk, relatively low reward trade. But again, these are where you get safe weekly paychecks, no gimmicks, no baloney, because you can also sell the weeklies. You're just not going to get a lot of money. Hey, why do you not sell short calls weekly? Sell 4 times the weekly premium will be greater than 1 month premium. No, I just said you absolutely can sell the weeklies. You don't have to sell the monthlies. I just happened to say that right before you did it, and basically what Jay is saying, and he's absolutely correct. I mean, if we go back to any of these positions, I mean, I think you understand it. You know, you're going to buy a long call. You're going to sell a short. You're going to buy a long dated call. You're going to sell a short dated call. And what Rushi is saying is, why not just sell a weekly? Because you can sell it 4 times in a month rather than take the monthly premium. And there's absolutely nothing wrong with selling a weekly. As long as your trajectory is fairly flat and you're not going to wind up getting a down move on the position, you're in great shape, and you could sell 4 positions every single month on the call that you purchased. Essentially, it's 4 covered calls you've sold in a month. The stock is sort of just sat there and done nothing. Your calls expire worthless, and you get it. You're going to get yourself, a decent net credit. Obviously, no home run, but you're going to get 4. You're going to get paid 4 times. So it definitely can be done that way. It's completely valid, and a lot of traders do it. And that's one of those weekly paycheck kind of strategies that people are willing to sell you for thousands of dollars. And that's one way to do it. If you just find one stock that between now and January you think is going to trade flat to slightly bullish, that's your direction. There's no such thing as flat. You're either flat, slightly bullish, flat, slightly bearish. You find a flat, slightly bullish. You can sell weekly calls against it almost all the way into December. You'll always want to have time decay on your side. So when you get into December, you're going to get, riskier, although the premium is going to get higher. Actually, your premium's going to get higher if you sell it, I believe. It's obviously riskier. Hey, selling covered calls on every Monday, Wednesday, and Friday for SPY against SPY holding long calls on SPY 3 months out. No, Jay, that is a terrific strategy. And I think everyone should take note of that. I mean, you just have to make sure that you believe that the SPY is going to either sit where it is, so you want to buy long calls on the SPY, and you can do that every single week. I totally agree with you. You sit with a covered call every Monday. So you're going to buy a long-term dated SPY. You're going to sell a short-term dated call. The SPY stays flat or up, you're gonna bank an SPY trade every single week. Hey, Suhas, it's ATI. Thank you. You got AT&T. No, that was T. That one I got right. Okay, Donald. Hey, Rory. You see Donald's comment? Okay, because Donald's just asking about the software. Hey, hi. Yeah, T is for AT&T. Hey, Richard. TMS is for T-Mobile. T-Mobile, it's not a stock I just have seen much cross the ticker on. I've seen some, but most of the action I've seen on AT&T. And I believe that people believe, big traders believe it has a much stronger, it's got a nice association with Comcast. It's got more upside on the T5 rollout. And it's not going to be a big mover, but if you're willing to sit with either a vertical spread or potentially a calendar spread, because it's really flat to bullish, it is not strongly bullish. It's not going to move a lot every day. And I'll tell you, it has its ups and downs. It's going to wiggle its way north, but not very quickly. You take a 3 or 4 month call position and you sell calls against it. You can make that a very, very profitable position. Yeah, thank you, Jay. Hey, Brian. When options plays say that a trade has a 34% chance, does it mean yes? That's exactly what it means, Brian. But remember that on an option, it always gives you, for some reason, a 30 to 40% chance of success. It never gives you a great chance of success, even on trades that I think are very, very, very likely to win. And I can sort of give you an example. Let's say we take a trade. Let's do it on Pfizer. And right now, Pfizer's at 42. So let's take a September 17. All right, well, let's take an August 13, August 20 spread where we're looking for 1 point. We're going to buy the 20 and now I'm sorry. Let's take the same strike, August 20. Okay. Now let me go a different way. This is July. We'll take the July 30, and we'll take the January 21, and we're going to buy the 42 and sell the 43. Now look at the option score is horrific on that. Now, what's the likelihood that that spread is going to be successful? You need 21 cents to make it to the upside, to make money on this position and close it. And if you look at the trade, it gives you 99%. So I'll have to take that back. Obviously, you're not going to make any money on it. But it just gives you about a 1/3 chance of success on almost every options trade you take. But remember, it is not inputting all the data that we know to swing the trade in our favor, Brian. One, it doesn't know that 10 million shares of T-Mobile were just purchased. 5 million in 2 block trades. I mean, it may not know that, $7.5 million of call positions were purchased on a particular financial instrument. It doesn't have the information. We're not just taking these trades blindly off the statistic that it puts up. or else we would essentially never take a trade. I mean, I really took a really poor trade on HIMS. So far, it's poor because of that announcement on Miley Cyrus. It bumped the stock a little bit, and then the stock's just sort of withered. But the announcement on Miley Cyrus is I consider to be a catalyst type of event. So we have a couple of catalyst events, and the statistic provided to you is just not operational because we know more than just the simple metrics of the tool. I mean, we're configuring it to create the best options we can. But the statistic in terms of success and failure, I mean, I got 35 straight winners going into the end of 2020. I mean, there's no way I could have done that unless I was using something that helped me propel me through that grim metric of 33%. And it really is almost UOA, although I do have in Benzinga, I keep all the block trades sort of, you know, I mean, I can show them to you, but you know, they're on a separate page. I archive them, you know, I think T-Mobile has got what was the block trade? It was a trade I missed. I think it was Levi Strauss that I just didn't leverage. So that's what tilted in our favor. When Levi Strauss has 10 million shares cross on two $5 million block trades, I don't care what the statistic is. We're going to format it optimally. We're going to take the best trade we can, and with that added information, we're going to tilt the trade way in our favor. Hey, Judy, you mentioned horizontal while on Levi. What is horizontal compared to a vertical or a calendar? A horizontal is a strongly bullish or strongly bearish position. So let's say we want to take a horizontal. Well, I'm sorry. There's a diagonal, there's a calendar, and when I said horizontal, what I meant vertical. I mean, those are our three spreads that we work with almost all the time: a diagonal, a calendar, or a vertical. And I'm sorry if I misspoke. I mean, there is no horizontal. What I meant to say, that price was going to move horizontal. And I'm sorry that I may have confused you on that, Judy. I'm glad you picked it up. It shows that you really understand what we're talking about. Hey, Rishi, will these trades be shared via email? Well, listen, you're going to get this on a link. These are not formal recommendations. Those come out of my Options Alert newsletter. It's, you know, if you want to subscribe to it, it's very cheap. Rory can put a link in the room, Rory, just really for Rishi if he's interested. You know, we're giving you our discount link. And that's where I give you the trades I call. And I'll tell you, on Sunday, I called a bearish trade on Beyond Meat. Now, it is not working. Beyond Meat had just on a technical basis set up horrible with no upside catalysts. And when I say it's not working, we've held it for 4 days, and we're down about 10 cents on it. So it's not like it's not working. It's just not going in our favor right off the bat. Let me tell you where we are on Beyond Meat. Oh, it's down $1.31 today. So I take it back. So it's actually evolving very nicely, and we're up money today on Beyond Meat. And that's so I took a 125, 110 vertical bear put spread. And I also recommended T-Mobile on Friday, which is doing exceedingly well. That's all the way out to January of 2020. I took an out of the money because I think it was cheap as heck. And we are really nicely up on AT&T. And I did it because of those 10 million shares. So those are like two formal trades. And what I do at the end of every week, most of the stuff that hits Benzinga, I put in the trash. All the stuff that I really think is important, I sort of stack and rack. And then starting on Saturday, I start sifting through it. And I go through what I think are the best potential trades that we can take. And those are the ones I send out. And sometimes I'll send them out during the week. It's an SMS text message service. If you're overseas, you'll get it through WhatsApp. Those are the trades I really, really love. I should have pulled the trigger on Levi Strauss. That was a mistake. It's doing really nicely today. I mean, Levi Strauss is inert, and it's moving. Now, there's still an opportunity to get it. Now, if you'll notice its technical score is very strong. Go to 1 month, it's still got a very strong technical score. It's got much shorter term resistance, but you see it's got a gap here to fill. I love those gaps because stocks really want to fill them. Now, I've read 15 times why they want to fill it, and I just don't remember. But I see Levi Strauss as a nice trade to the upside. And it may be one that I pull the trigger on Sunday night. I don't want to take a lot of risk in today's market. We've already got a lot of risk in the portfolio right now. Oh, I also recommended Asana, which took a big nosedive one day and came back like a house on fire. And we're up on the position. It's ASAN. I have a 70-85 call spread. It's at $71.32. It's up $1.23 today. I love that stock. Asana is the competitor right behind Slack. If you know what Slack does, and we use Slack here in the office, it's a tremendous tool to coordinate tasks between your employees. Now, let's say like we do, we have employees overseas. We have a very important company we work with in Germany. And let's say we want to talk to them. Slack is just a tremendous tool for uploading videos, sending emails, all kinds of stuff. Asana is almost a blueprint of Slack. Now, Slack was purchased by Salesforce.com, and you can't trade it anymore. But Asana is coming up like a house on fire because these companies just need a way to coordinate tasks across the globe. And you just can't do that via email. And I'll tell you just one other thing. I don't want to go into a big song and dance about Asana, which is like Slack. Let's say you're the president of the company and you want to send a message to a select group. So you'll have one thread for the CEO, CFO, vice presidents, so you can select who the message goes to. It's really a very clever and powerful tool. So I went with Asana. I also saw unusual options activity. I mean, I really think it's a great position. So I think I took T-Mobile the week before because I think I took Asana and Beyond Meat, and they're both moving in our favor. I think Beyond Meat has got a move down of an additional 20 to 25 points. Okay, Don, great, thank you. Apple provides a great weekly premium. Sell against the long call. I love that idea. I really do. Just stay away from, very smart, Jay. And what Jay, I want to tell everyone what he recommends doing. Now here's Apple. Let's take it out a little bit further. You know, it fell on earnings. And obviously this is not a strategy you use around earnings. But you take a technically really powerful stock like Apple, like Microsoft. And let's look at MSFT. So what you do is you create a calendar spread on Microsoft. So you're going to buy the Microsoft. We'll take it all the way out to January. And then what we're going to do is, well, it's January 285. And we're going to sell. It's got to be the same strike. Right here at 285. We'll sell the September 285s. And what we can expect is just a little bit of a move up, a little bit of a move up. And every time, I mean, what Jay is recommending, he likes to do them on a weekly basis. So this is 729. So we would go here to, it's a little early, it's a little late for 730, but we go to August 6th. We're going to sell a $3.65 position. And as long as Microsoft continues to make its upward trajectory, now it's an expensive spread, but we're going to be selling calls against it for months. Now he wants to sell them on a weekly basis. So in 1 week, this is going to expire. And if it doesn't come down, we can look at the our downside for a loss is 279. Man, that's a long way down. I'll tell you that. Its break even to the upside is 291. And I see Microsoft just sitting there for a long time on a sideways move after earnings. I don't see any major moves up. And I think this might be a terrific stock to trade, using that strategy. So it's got a terrific options play score right here. So that's a great way of using it, Jay, and I really appreciate your throwing that into the room. I think it's a really, really nice strategy. I really do. Oh, I got you. It doesn't take any UOA or catalyst event into account. Right, exactly, Brian. Like, we're just not taking that statistic, as the only thing. We wouldn't even consider that position based on its statistic unless we knew a lot more information than just a tool looking at the Greeks does. And that is UOA, monster block trades placed continually over and over and over again. We've got to tilt the risk, that percent win way in our favor. And that's why I sit there and go through 150 to 200 emails a day, is to do just that. Is to throw the risk to reward in our favor, overcoming that intrinsic, 33% to 50% win rate if you just go off the options metrics. So I hope you got a lot. Jay really contributed a lot to this webinar. I'm telling you. I mean, after earnings on Microsoft, I would give it another few days. I hate to throw out a position that's just expensive. I don't like to throw out a $1,500 or $1,400 position on the Options Alert newsletter. I sort of like to keep them fairly inexpensive. But there are lots of stocks moving sideways to slightly bullish. And I'll tell you, you can sell calls against them. If you take a January, you can sell 4 calls against them a month, and every day collecting a net premium. Now, nothing's in the bag and nothing's guaranteed, but it's simply a way of tilting everything in your favor and looking to leverage a stock that's neutral to bullish. Okay. All right. Well, listen, everyone, I hope you got a lot out of this. You know, it's a lot easier to do it than to teach it. They always say, do one, teach one, or teach one, do one. I can't remember the old adage. But I mean, I hope this gave you a better feel for what we're looking for on a trade, how I go about making an assessment on a trade. I love this tool. You can get it for nothing. I mean, it's really, you know, $100 and a little bit of paperwork. You open up a First Trade account and you can use this thing until the cows come home. The amount of money I put in First Trade like 8 years ago is the same amount of money that's in First Trade today. They give me no, I don't think they give me any interest, which I don't care. It's not that much money. You can open the account with $100. Just make sure that you get approval to trade options, and they will enable the options tool for you. You can use it till the cows come home. And I really, really like it. Okay. Okay, Andrew. I really appreciate it. Listen, everyone have a wonderful afternoon. Thank you for joining me. This will come out to you on a link if you want to review any of it. Jay, I thank you for your advice and your input. Very, very, very powerful strategy and really good advice. Much appreciated. Everyone have a wonderful afternoon, and I look forward to seeing you tomorrow morning. I want to eclipse $2,000 tomorrow in the room for the week and close out, even though I missed those trading sessions because of my reflux. It is horrific. It's like I swallowed Drano. Okay, my pleasure. Everyone have a wonderful afternoon. Bye-bye, everybody.